You see the headlines everywhere. Massive companies combining forces, multi-billion-dollar takeovers, the kind of deals that redraw industry maps and capture everyone's attention.
Yeah, they really do.
And for a certain type of investor, these moments aren't just news, they're potential opportunities. We're talking about the world of U.S. mergers and acquisitions, or M&A.
Right.
But here's the thing, announcing a deal, shaking hands for the cameras, that's only the beginning. A significant number of announced deals never actually make it to the finish line. They break.
That's the fundamental reality. While the potential reward in M&A lies in the difference or the spread between a target company's stock price after a deal is announced and the price the buyer is offering.
That gap.
That gap, exactly. It exists precisely because there's risk. The market isn't giving you the full offer price instantly because, well, it's just not certain the deal will close.
And for investors who live and breathe this space, those who employ a strategy known as merger arbitrage, assessing and managing that uncertainty isn't just part of the job, it is the job.
It's the core principle, really.
It's the absolute core principle. You know, even legendary figures like Warren Buffett understood this value. He used merger arbitrage early on, seeing it as a prudent way to deploy capital when long-term equity opportunities weren't abundant.
And Buffett's famous rules, never lose money and never forget rule number 1, they resonate deeply with the philosophy of successful merger arbitrage.
Definitely.
It's not about trying to pick the next tech giant or, the energy stock that's going to double. It's about meticulously assessing the probability of a specific event happening, a merger closing.
It's just that one event.
Just that one event. And positioning yourself to capture a relatively small, predictable profit while putting robust protections in place to avoid significant losses if the event doesn't happen.
It sounds less like trying to hit a home run and more like consistently hitting singles or doubles, accumulating those small, steady wins.
That's a great analogy.
John Paulson, famous for his big bet during the 2008 financial crisis, also emphasized this when it comes to arbitrage, saying it's not about making money, it's about not losing money. That focus on downside protection feels absolutely critical.
It is. It absolutely is. And it demands a very specific blend of skills. You need strong analytical capabilities, the quantitative chops to model and crunch numbers, but also really sharp qualitative judgment.
So not just the math?
Not just the math. You're looking at business fundamentals, yes, but also diving deep into complex legal contracts, understanding regulatory landscapes, even factoring in international politics and the sort of strategic game being played between the different parties involved.
Oh, okay.
Experience in navigating this intricate landscape is invaluable, but, understanding the foundational process is the essential first step.
So for this deep dive, we're pulling back the curtain on exactly that. We're going to explore, through the lens of merger arbitrage, how investors assess the probability that a U.S. M&A deal will actually close.
Right. How likely is it, really?
We'll dig into how they find opportunities, analyze the absolutely critical documents, quantify the potential risks and rewards, manage their portfolios to weather inevitable deal breaks, and navigate the increasingly complex modern regulatory environment.
We're looking at the disciplined approach the pros use, drawing insights from practitioner guides and analyses of the current landscape to turn market events into investment opportunities while always keeping that risk management first principle in mind.
All right, let's get into it. If I'm an investor looking at merger arbitrage, what does the process even look like? I mean, how do I start?
Well, at its heart, the concept is quite simple. You have Company A announcing it wants to buy Company T for a specific price per share.
Okay.
Let's say Company A offers $60 per share for Target T. Before the announcement, Target T might have been trading at, say, $45.
Okay, so when the deal is announced, Target T's stock price is definitely going to react.
Exactly. It jumps, often significantly, but crucially, it usually doesn't jump all the way to the $60 offer price immediately. It might trade at $57 or maybe $58.
Sure.
That difference between the offer price of $60 and the current trading price of $58 is the spread.
And the merger arbitrage play is to buy shares of Target T at $58, anticipating that when the deal closes, you'll receive the full $60 offer price. That $2 difference per share is your target profit.
That's the core idea. If it's an all-cash deal, your trade is pretty simple. Buy the target stock.
Just buy T.
You hold it, wait for the deal to close, and then you receive $60 cash for each share you own. Pretty straightforward.
But what if it's a stock deal or maybe a mix of cash and stock? Gets trickier then.
That's where it gets more interesting, yeah. and where the risk management gets more active. If Company A is offering, say, 1.5 shares of its stock for each share of Target T,
Right.
the arbitrager buys Target T stock, but they also typically short sell shares of Company A.
Why short the buyer's stock? What's the rationale there?
Well, it's primarily to neutralize the market risk, for the most part. In a stock deal, the ultimate value of the consideration you receive is tied to the acquiring company's share price. So if Company A's stock drops significantly, the value of the offer goes down. By shorting Company A's stock, you're hedging against that price movement. You want your profit to depend purely on the deal closing, not on the general performance of the acquirer's stock or the overall market.
Got it. Isolating the deal itself.
Exactly. When the deal closes, you receive Company A's shares for your Target T shares, and you use those newly received shares to cover your short position in Company A, locking in that spread.
So the strategy is really about isolating that specific deal closing probability from broader market ups and downs. It's almost like creating your own little market neutral situation for that deal.
Precisely. It's about capturing that yield from the spread, which is why it's often seen as having low correlation to traditional market movements. It's fundamentally a risk-managed approach focused on, not losing money if things go wrong.
Given that you're looking for relatively small, consistent returns, and the average deal duration is only around 3 months, you must need a constant stream of potential opportunities to build a portfolio.
Absolutely. This isn't a buy and hold strategy in the traditional sense. It has high turnover. And to build a sufficiently diversified portfolio, you need a very wide research funnel.
A funnel, okay.
The goal is to identify and track every publicly announced merger or acquisition opportunity you can find. You want a big opportunity set.
So where are these opportunities coming from? How do you cast that wide net? Is it just reading the Wall Street Journal?
Oh, it's much more than that. It's a multi-pronged approach.
Yeah.
You're constantly monitoring digital media, major news outlets, industry-specific trade publications, even keeping an eye on financial social media for early rumors or leaks sometimes. You rely on sophisticated proprietary data screens that scan news wires, regulatory filings, stock exchange data for announcement keywords or unusual trading patterns.
The machines help.
Oh, definitely. And sell-side research desks at investment banks are also a key source. They cover M&A activity extensively. The objective is basically to feed all of these potential deals into your internal tracking system or database. Get everything on the radar.
Okay, you've identified a deal announcement. It hits the wires. What's the absolute first analytical step?
Once the announcement hits, the immediate first step is to input the core details of the deal into your valuation model. These models are typically built on extensive historical data from previous M&A transactions.
Right.
And they provide an initial framework for assessing the offer terms, kind of a first pass.
And what are the absolute must-read documents right out of the gate? If you only had time to read 3 things initially, what would they be?
You absolutely must read the press release announcing the deal. That's number 1. Then the full merger agreement, which will follow shortly after, and then down the line a bit, the proxy statement or tender offer documents that are filed, those 3.
Let's start with that initial press release. What critical information are you extracting from that first announcement? Seems like the headline grabber.
It is, and this is where you get the skeleton of the deal. You need to know exactly who's involved, the target company and the acquiring company. Basic stuff, but crucial.
Who's buying whom?
Right. And is it a friendly deal, supported by the target's board of directors, or is it an unsolicited potential hostile bid? That sets the initial tone, big difference.
Got it. Players and the nature of the negotiation. What else is crucial from the press release?
Okay, the specifics of the consideration. How is the buyer coming? Is it all cash, all stock, or some combination?
The payment method.
Yes. Are there any complex elements like a special dividend, preferred shares, or maybe a spinoff involved? And critically, what is the precise value of the consideration per share being offered? The price tag.
And the legal structure. Does that matter early on?
Oh, absolutely. The transaction structure.
Yeah.
Is it a standard merger? Is it a tender offer when the buyer offers to buy shares directly from shareholders? Or something specific to jurisdictions outside the U.S., like a plan of arrangement or amalgamation?
Okay.
And importantly, is this a definitive agreement, a legally binding contract, or is it just a non-binding letter of intent, LOI, or memorandum of understanding, MOU? That's huge.
I'd imagine a definitive agreement is a prerequisite for investment for most arbitrageurs. You wouldn't touch an LOI.
Absolutely.
Yeah.
Generally, no. LOIs and MOUs are far more likely to fall apart. Too much uncertainty. You also identify the buyer type. Is it a strategic buyer looking for synergies within their industry, or A financial buyer, like a private equity firm doing a leveraged buyout, LBO.
Strategic versus financial.
Okay.
Sure.
What's the premium being offered over the target stock price before any rumors or the announcement of the unaffected price? What's the total transaction size? Big deals face different hurdles than small ones.
The rationale behind the deal, do they spell that out?
Usually, yeah. They outline the strategic rationale and expected synergies. Yeah. Why do they think bringing these companies together makes sense? Is the deal expected to be accretive to the buyer's earnings?
Yeah.
They'll usually give an expected timeline for completion, though take that with a grain of salt early on.
And financing.
Very important. If it's a cash deal, you look for financing details. Who is providing the funding and what are the terms? Is it committed financing or just a highly confident letter? Big difference.
Any conditions mentioned up front, like regulatory hurdles?
Typically, the press release will highlight the
Requirement.
major conditions.
Yeah.
Things like regulatory approvals, antitrust, maybe CFI US, and shareholder votes. You also note the advisors involved, reputable investment banks and law firms, can add a layer of confidence.
Interesting. Does the quality of the advisor matter?
It can, yeah. It signals seriousness. Also, look for things like a go-shop provision, allowing the target board to solicit other offers. Or did the deal result from a formal review of strategic alternatives processed by the target? That suggests they already looked around. And are there any shareholder lockups or voting agreements where major shareholders have committed to supporting the deal? That has certainty.
Wow. That's a wealth of information just from that initial announcement. It's not just the price.
Not at all. It's the whole context. And you're not stopping at just the press release text. You're immediately looking for accompanying regulatory filings, like an 8K with the SEC, listening to the conference calls that companies hold for investors and analysts.
Right, the call transcripts.
Exactly.
Yeah.
And reviewing any investor presentations. These can contain incremental details or important nuances. Sometimes even just the tone of management can tell you something.
And how do you use all that data for an initial analytical pass? What's the first thing you're trying to figure out?
Well, one key piece is performing an initial valuation analysis. You compare the valuation metrics of the target company based on the offer price, things like price to earnings or price to sales ratios, EV/EBITDA, that sort of thing.
Standard metrics.
Standard metrics, yeah. You compare those to comparable public companies and recent precedent transactions in the same sector. This helps you form a judgment on whether the offer price seems full or potentially low.
Why does the fairness of the price matter so much to an arbitrager? I thought it was just about capturing that existing spread.
That's a great question. It's not just about the current spread. If your analysis suggests the offer price is low relative to peers or precedents, it doesn't necessarily mean the deal will fail. But it could signal that the target company was maybe undervalued, or the buyer sees significant upside not reflected in the initial price.
Ah, okay.
And this increases the possibility of a competing offer emerging from another buyer willing to pay more. For an arbitrager who has longed the target stock, a bidding war is a highly desirable outcome. It means a potentially larger spread and a higher return. So a low price can sometimes be good news, paradoxically.
Okay, so the press release provides the initial facts and figures, the skeleton. What about the merger agreement? What does that add? Sounds much heavier reading.
It is. The merger agreement is the legally binding contract between the two companies. It comes out usually shortly after the press release and is significantly more detailed. It lays out all the terms and conditions in painstaking legal language, often providing critical information that wasn't immediately public. This is where the real details are.
What are some key things you're digging for in the merger agreement? What jumps out?
Absolutely critical details. Things like break fees. These are payments one party agrees to make to the other under specific termination scenarios.
Right, the penalty clauses.
Exactly. A seller might pay a fee if they accept a higher offer from a different buyer. That's the standard break fee. Or, increasingly important now, a buyer might pay a reverse termination fee if they fail to obtain financing, or, more commonly, if the deal is blocked on regulatory grounds.
So it clarifies the financial consequences if the deal breaks. Who pays whom and why?
Precisely. It also specifies the hard termination date or outside date. This is the deadline by which the deal must close, or either party typically has the right to terminate. This date is absolutely crucial for calculating your annualized return, your yield.
The clock is ticking towards that date.
It is. And critically, the merger agreement lists all the specific conditions to closing, not just the major ones mentioned in the press release. Are there specific regulatory approvals needed beyond the obvious? Are there requirements tied to the target's business performance before closing, like no material adverse effect?
All the hurdles that need to be cleared.
All the hurdles. And financing commitments.
Again.
especially for cash deals or LBOs. The agreement details whether the buyer has secured committed third-party financing. Is it truly locked in, or are there still outs for the lenders? This is a major potential point of failure, so knowing the strength and certainty of the financing is vital.
And the proxy circular, that seems to come later in the process. What's its role?
The proxy circular, or sometimes a tender offer document like a Schedule TO, is required by regulators and sent to shareholders, usually several weeks after the initial announcement. It's basically the document asking shareholders to vote yes on the transaction or tender their shares into the offer. It's a deep dive into the deal itself.
What unique insights does the proxy circular offer that you don't get elsewhere?
Often, the most insightful part is the background of the negotiations section. This legally required disclosure details the history of how the deal came about, the initial contacts, the back and forth on price and terms, any competing interests or bids that were considered.
Like the story behind the deal.
Exactly. Reading this narrative can sometimes reveal dynamics or potential sticking points that weren't obvious from the press release. It can give you a feel for how robust the process was, how motivated each side is, which can impact your assessment of deal certainty. It will also usually provide an updated, perhaps more realistic, estimated timeline for completion.
So you're piecing together the full story from these documents, the initial facts, the legal obligations, the negotiation history. Once you have this richer picture, how do you translate that into a potential investment decision? How do you actually quantify the opportunity?
Okay, this is where the quantitative analysis takes center stage, building on all that detailed document review and qualitative assessment. You generally focus on two primary calculations: the merger yield and the implied odds of success.
Let's break down merger yield first. What exactly is that measuring?
The merger yield is essentially your estimated annualized rate of return from capturing the deal spread. It takes that potential dollar profit per share, the spread, and projects it over a year, considering how long you expect the deal to take to close.
So it's not just about the percentage spread itself, but the time it takes to realize it. A small spread closing quickly could be better than a big spread taking forever.
Exactly. Time is a huge factor. The calculation requires defining the merger consideration, the total value you expect to receive per share. For a cash deal, it's simple. It's the cash amount. For a stock deal, it's the exchange ratio multiplied by the acquirer's current share price. If there are any expected dividends from the target before closing, you'd add those in as well.
Okay, the total value received.
Then you calculate the net spread. That's the merger consideration minus the target's current share price. After accounting for estimated trading commissions and, critically for stock deals, any cost of borrowing the acquirer's stock to short. Borrow costs can eat into your spread.
Right, got to factor in the costs. And the formula annualizes that net spread.
Yes, the standard formula is basically 1 plus net spread current share price raised to the power of 365 divided by the estimated days until completion minus 1. This gives you the annualized yield percentage.
And a key question here is straightforward, isn't it? Is that calculated merger yield attractive enough to compensate you for the risk involved?
Precisely. Does it exceed your required rate of return or your cost of capital? Is a potential annualized profit worth the risk that the deal might not close, that you might lose money instead? That's the fundamental trade-off.
Okay, that covers the potential return side. What about assessing the risk quantitatively? You mentioned the implied odds of success. How does that work?
This calculation tries to leverage the market's collective wisdom, as reflected in the target company's stock price. The spread itself, that gap between the current price and the offer price, is essentially the market's assessment of deal risk.
So the market is telling you something by how it prices the target stock.
Exactly. The implied odds are calculated based on the potential gain if the deal closes versus the estimated potential loss if it breaks. You're comparing the upside to the downside.
So how do you define those potential outcomes? Upside seems simple enough.
Yeah, the upside is the potential gain if the deal closes. Merger consideration minus the current share price. Pretty straightforward. The downside is your estimated loss if the deal fails. This is trickier to estimate.
How do you estimate that?
Typically, you look at the target stock's price before any rumors or the announcement, its unaffected share price. If the deal breaks, the stock is likely to fall back towards that unaffected level, or maybe even below it, depending on the reasons for the break in current market conditions. So downside is roughly the current share price minus the estimated unaffected share price.
Got it. The potential loss if it collapses. And the formula ties those together.
Yes, the common formula for the implied odds of success is downside divided by the sum of the upside plus the downside. So odds equals downside, upside plus downside.
Okay, let me wrap my head around that. Downside divided by total potential swing.
Right. This formula translates the market's pricing of the stock, how wide the spread is relative to the potential loss, into a probability estimate for the deal closing. If the stock is trading very close to the offer price, the spread upside is small. The downside relative to that upside is high, implying the market sees a high probability of closing.
And if the spread is wide?
If the spread is wide, the upside is large relative to the downside, implying the market sees a lower probability of closing, more risk.
That's a powerful concept, using the market's own behavior, its pricing, to gauge the perceived risk.
It is. It's a key input. And this implied probability, along with all the qualitative analysis of the deal terms, the regulatory hurdles, financing risk, all that stuff we talked about, it feeds into proprietary risk rating systems used by practitioners. The source mentions a system called Alpha Rank, for example.
Alpha Rank, what does that involve?
It assigns ratings like AA, BBB, BBCCC, and NR based on a comprehensive assessment of closing probability. It combines factors like the implied odds we just discussed, but also the assessment of regulatory risk, financing risk, shareholder approval likelihood, and the overall deal structure and terms.
What do those ratings mean in practice? Is BBB like investment-grade bonds?
Kind of analogous, yeah. They signify the assessed probability of the deal closing. AA represents the highest probability, minimal conditions, high certainty. A is very high probability. BBB is considered investment-grade risk by the source, meaning a high probability of closing. Generally well-structured deals with clear paths to completion.
And below BBB?
BB is more speculative, perhaps facing a known regulatory hurdle or financing condition, but still typically assessed at over a 90% probability of closing. B is more speculative still, maybe over 85%. CCC is highly speculative, indicating significant unsatisfied conditions or major known risks. You'd need a very wide spread to compensate for that. NR means not rated. Maybe the stock is trading weirdly for other reasons.
And these ratings directly guide how much capital you put into a deal. It's not just invest or don't invest.
Absolutely. This is a direct link between analysis and portfolio construction, managing risk. Higher rated deals, AAA, BBB, are deemed lower risk and therefore receive larger capital allocations in the portfolio. Lower rated deals, BBB, CCC, are either given smaller allocations or avoided altogether if the risk-return profile just isn't compelling.
That makes sense.
Historically, the source notes, roughly half of friendly announced deals have fallen into that BBB or higher category, considered investment grade from a closing probability perspective.
We've focused a lot on assessing the probability of success, but the flip side, of course, is the risk of failure. You mentioned deals do break. What are the most common culprits? The primary reasons merger transactions actually fall apart.
Yeah, understanding why deals fail is just as important as understanding why they succeed. Based on analysis of historical data and practitioner experience, there are typically 5 main reasons. The first 2 are regulatory, and they're becoming increasingly important these days.
Okay, what are they?
The first is antitrust regulatory blocks. In the U.S., this happens if the Federal Trade Commission, FTC, or the Department of Justice, DOJ, challenges the deal in court. They'll argue it would substantially lessen competition in an industry, maybe leading to higher prices or less innovation, and ultimately harm consumers.
So the government's stepping in to say, no, this consolidation is bad for competition.
Precisely. The second regulatory risk is foreign investment regulatory blocks. If the buyer is a non-U.S. company, the Committee on Foreign Investment in the United States, or CFIUS, reviews the transaction for potential national security risks.
CFIUS, right, we hear more about them now.
Definitely. If CFIUS determines the deal poses an unacceptable risk to U.S. national security, it can recommend the president block it. And CFIUS scrutiny has significantly increased in recent years. It's a major factor now.
Okay, 2 big regulatory hurdles. Beyond those, what about the financial side?
Financing failure is a major one. This is particularly relevant for leveraged buyouts led by private equity firms, which rely heavily on debt. If the buyer's relying on external financing, getting loans from banks or issuing bonds, and that financing falls through, maybe due to market conditions changing, lender cold feet, or issues with the buyer's own creditworthiness, the deal often cannot close. The money just isn't there.
The funding dries up, makes sense. And shareholder approval.
Yep, shareholder vote failure. Many deals require the approval of the target company's shareholders, and sometimes, as we'll discuss later, the buyer's shareholders too. If a significant percentage of shareholders vote against the deal, it fails.
Why would they vote no?
Usually because they believe the offer price is too low, or perhaps if a better offer emerges from a competing bidder after the initial deal's announced.
Right.
Activist investors might also campaign against the deal.
And the last main reason, just changing minds.
Pretty much. The fifth reason is simply the buyer gets cold feet. The acquiring company might just decide they no longer want to complete the transaction. Maybe the target's business has deteriorated significantly since the deal was signed. Maybe broader market conditions have changed dramatically, or maybe there's just a change in strategic direction at the buyer.
Can they just walk away?
Whether they can walk away without penalty, or if they have to pay that reverse termination fee we talked about, depends entirely on the specific terms negotiated in the merger agreement. This often leads to litigation, trying to force the deal closed or collect the fee.
Okay, so you've done your analysis, assessed these potential deal-breaking risks, made an investment. Does your work stop there? Just wait for the check.
Absolutely not. No way. Once you're in a position, you enter monitor mode, but it is anything but passive. You have to maintain constant vigilance over everything that could potentially impact that deal's closing probability, both negatively and positively.
What does that involve day to day? What are you watching?
You're monitoring all news and press releases from both the target and the acquirer, obviously. Their quarterly earnings reports are critical. Is the target company performing as expected? Is the buyer still healthy? Any unexpected good or bad news can definitely sway things.
Beyond the company specifics.
You're watching the specific sector the companies operate in. Is there a major change in commodity prices if it's an energy or materials deal? The source mentions, for instance, a sudden drop in gold prices could impact a gold mining deal. Is there a new technology breakthrough if it's tech? You're also watching the broader market and the overall economic climate, interest rates, recession fears, etc. Any hint of increased risk needs to be identified immediately.
And you're also hoping for positive developments, right? Not just watching for disaster.
Yeah, absolutely. You're always looking for signals that could lead to a more favorable outcome. Stronger than expected performance from the target or positive regulatory momentum could encourage the original buyer to bump their offer price to ensure shareholder approval or fend off potential rivals.
Price increase.
Or it could attract a competing bidder, leading to a bidding war. That's the arbitrager's dream scenario, really. A higher price means a larger spread and a better return.
Okay, we've covered identifying risks and monitoring them after investing. But before you even put capital to work, you need a system to avoid the deals that are just inherently too risky from the start. Is there like a checklist of things that would make you just walk away immediately no matter the spread?
Yes, and this is absolutely fundamental to that never lose money principle. Successful arbitrageurs have a strict risk mitigation checklist, a set of red flags that mean you simply don't invest in that deal, regardless of how tempting the potential yield might look initially. Job number one is avoiding the blowups.
What are the absolute pass signals on that checklist?
Okay, first, buyer credibility. If the acquiring company has a known track record of announcing deals and then failing to close them, or if there are serious questions about their financial stability or their capability to actually fund the acquisition, that's an immediate red flag. You need a credible, capable buyer.
Makes sense. And the funding source.
Similarly, if the financing source lacks credibility or the funding structure is opaque or overly complex, particularly for large cash components or LBOs, depending on junk bonds, maybe stay away. You want clear, committed financing.
We touched on definitive agreements earlier. That's on the list.
Absolutely. If the deal is non-definitive, it's just an LOI or MOU, not a signed binding merger agreement pass. The probability of these preliminary deals breaking is significantly higher than definitive agreements. You wait until the ink is properly dry on the contract.
What about hostile deals? Are they always a no?
Generally be very cautious with hostile deals. They can sometimes offer opportunity, sure, but they inherently carry more risk. The target management is actively fighting the deal, which introduces uncertainty and can sometimes introduce unwanted market beta if the fight gets really public and messy. Friendly deals are usually preferred.
What about regulatory risk? Some sectors or combinations just seem destined for intense scrutiny from the start.
Right. If the regulatory risk is obviously excessively high, particularly in complex antitrust cases involving significant market share consolidation in concentrated industries, or deals with clear national security implications for CFI US, the source advises extreme caution and potentially just passing. You don't want your investment outcome to rely purely on luck or a regulator's unpredictable decision. You need a reasoned, identifiable path to regulatory approval, even if it involves planned divestitures or remedies.
Okay, so we've got buyer credibility, financing credibility, definitive agreement status, avoiding hostile deals, and avoiding excessively high regulatory risk. Is there one more major, perhaps less obvious red flag that really stands out?
Yes, there is. And this is arguably the single most important red flag, one that has caused significant pain for many arbitrageurs, including, as the source hints from personal experience, themselves. It's the buy-side vote pitfall.
A buy-side vote? You mean the acquiring company's shareholders have to vote to approve the deal?
Exactly. This condition is typically required when the acquirer is issuing a large amount of new stock to pay for the acquisition maybe more than 20% of their outstanding shares. Because this issuance can significantly dilute the ownership stake and potentially the earnings per share for their existing shareholders, those shareholders are often granted a vote by stock exchange rules on whether to approve the transaction.
And why is that so dangerous for the arbitrager who's betting on the deal closing?
Because requiring the acquirer's shareholders to vote essentially puts the acquiring company itself in play as a potential takeover target. Think about the setup from the arbitrager's perspective.
Okay.
You, the ARB, are long the target company. Key. Betting its stock goes to the offer price when the deal closes. If it's a stock deal, you're also likely short the acquirer's stock, A, to hedge against market movements in A's price.
Right. Long T, short A.
Now, imagine another company, let's call them an interloper, I, sees that company A, the acquirer, is maybe a bit vulnerable because they need their own shareholder approval for the deal to buy T. The interloper decides this is a good time to launch a bid to buy company A itself, offering a premium price for company A's stock.
So company A, the original buyer, suddenly becomes the target.
Precisely. Now, company A shareholders have a choice. They can vote for the original merger, where A buys T using A's stock, or they can vote against that original merger and instead accept the interloper's tempting cash offer, which gives them a nice premium for their own shares in company A.
Their financial incentive seems pretty clear there.
Overwhelmingly clear. They will almost certainly vote against the original merger with T in order to tender their shares into the higher offer from I for their own stock. Why approve a deal that dilutes them when they can get bought out at a premium instead?
Which immediately causes the original A buys T deal to break.
Yes, the original merger agreement fails because a required closing condition, the buyer's shareholder approval, is not met. And that, for the arbitrager, is the absolute worst-case scenario. Nightmare territory.
Why, worst case, both legs of the trade go wrong.
Exactly. Your long position in the target company, T, collapses because the deal is dead, and T's stock price plummets back towards its unaffected price, maybe lower. Big loss there. But simultaneously, your short position in the acquirer company, A, explodes higher because it is now the subject of a premium takeover bid from IR. Huge loss on the short side, too. You get hit hard on both sides of the trade, potentially suffering a massive, crippling loss from a single position.
Wow. That scenario sounds incredibly painful and kind of counterintuitive. The buyer getting bought is what sinks your position in the target?
It's a critical, hard-learned lesson in the arbitrage world. If a deal requires the acquirer's shareholder vote for approval, the strong advice from the source's experience is just pass, walk away, find another opportunity. The risk of the acquirer being put in play and outbid is too high, and the consequences for the arbitrage trade are just too severe to bear. Avoid it like the plague.
So you've navigated the checklist, avoided the major pitfalls like the buy-side vote, done your analysis, calculated your yield and implied odds, used your alpha rank to assess the risk. But even with a rigorous process, as you said, some deals will inevitably break. It's a numbers game. How do you manage that reality across an entire portfolio? You can't win every time.
No, you definitely can't. And this is where disciplined portfolio management, specifically position sizing and diversification, becomes absolutely crucial. You know statistically that a certain percentage of deals will fail. The historical data cited suggests about 6% of announced U.S. deals have broken legitimately. Acknowledging that reality up front is key. You manage your exposure before you invest, not after.
How does position sizing help mitigate the impact of one of those inevitable deal breaks?
The core goal of position sizing is to limit the maximum potential loss from any single deal failure to a predefined acceptable percentage of your total portfolio's net asset value, NAV. You decide on a pain threshold, maybe something like -2% of NAV for any one break.
Okay, limit the damage from any one mistake.
Exactly. To do this, you calculate the maximum size of any individual position based on your estimated downside if that specific deal breaks. For example, if your analysis determines that the target stock could realistically fall by one-third, 33% of its current value, if the deal fails, on or downside,
Right.
then your maximum allowable position size in that deal would be 6% of your portfolio's NAV. That way, if the worst happens and the deal breaks causing a 33% loss in that position, your total portfolio loss from that one event is limited to roughly 6% times ALDIO,
Right.
which equals 2% of NAV.
So the riskier the potential downside if it breaks, the smaller the position size has to be to stay within that 2% loss limit.
Precisely. This is where the alpha rank rating comes back into portfolio construction. Riskier deals, rated BB or lower, will generally have a larger estimated downside on break compared to higher rated deals, BBB+. This naturally leads to smaller initial position sizes for those lower rated, higher risk deals, automatically aligning your risk tolerance with your capital allocation.
And how do you estimate that deal break price accurately for the sizing calculation? You mentioned the unaffected price earlier.
It's an estimate, of course,
Yeah.
but it's based on several factors. You start with the stock's unaffected price where it was trading before any deal rumors surfaced. Then you adjust that baseline based on how comparable companies in the same sector are currently trading, how the sector as a whole has performed since the deal was announced, has the whole group gone up or down, and any significant changes in the target company's fundamental business performance or outlook since the deal signing. It's not an exact science, but it's a reasoned, data-driven estimate of where the stock might settle if the support of the deal disappears.
You mentioned the historical statistics. 6% of deals break, but also, interestingly, 6% get revised upwards. That seems significant for a portfolio approach, doesn't it? The winners helping pay for the losers.
It's a very important point for the overall portfolio outcome over time. It's a key part of why diversification works here. While breaks cause losses, historically about 6% of deals, historically about the same percentage, around 6%, have seen their offer price revised upwards.
How does that happen?
It could be the original buyer sweetening the pot, maybe to ensure shareholder approval or lock the deal down. We call that a bump. Or, as we discussed, a competing bidder emerges, forcing the price higher in a bidding war.
So over a portfolio of many deals throughout the year.
Exactly. If you're actively trading many deals, say, investing in 50 different announced transactions over the course of a year statistically, you might expect to experience around 3 deal breaks, 56%, which will obviously cause losses. But you might also see around 3 deals get a price bump, 56%, which adds additional, sometimes significant profit beyond the original spread. Over a well-diversified portfolio, these upward revisions can help cushion or sometimes even completely offset the losses from the inevitable deal breaks, helping to smooth out the portfolio's overall returns. It's the law of large numbers working in your favor, provided you're diversified.
This strategy is often run with leverage, right? Because the individual spreads can be small. Does that impact portfolio management significantly?
Yes, that's a critical point. Because merger arbitrage typically offers relatively low returns on an unlevered basis, and it generally has low correlation to broad market beta, it is very frequently run with leverage to enhance those returns. The source mentions a typical sweet spot often being somewhere around 150% to 200% gross exposure.
Meaning your total positions are 1.5 to 2 times your actual capital.
Correct. Total long positions plus the absolute value of total short positions add up to 1.5 to 2 times your underlying net asset value. Leveraging obviously increases potential returns, but it just as obviously magnifies potential losses, making that disciplined position sizing and diversification even more critical. There's less room for error when leveraged.
And diversification isn't just across individual deals, but other factors too.
Definitely. It's also important to diversify across different industry sectors. You don't want too much concentration in a single industry that might suddenly face specific cyclical headwinds or unexpected regulatory risks affecting multiple deals at once.
Right. Avoid putting all your eggs in one sector basket.
And it's also prudent to limit your overall exposure to deal types that are heavily dependent on the credit markets, like large LBOs, as they can all become vulnerable simultaneously if financing conditions tighten unexpectedly across the board. The fundamental principle remains the same. Managing position sizes carefully and diversifying exposures broadly are your primary tools to stay out of serious trouble and, as the saying goes, live to fight another day when a deal inevitably breaks your way.
Let's talk about something that's clearly adding significant complexity to this whole world right now: the evolving U.S. regulatory landscape. The sources highlight pretty noticeable changes, particularly since around 2020, regarding how antitrust and foreign investment reviews are being handled. How is this impacting M&A deals and the arbitrage strategies that follow them?
This is a huge factor today, It's where the rubber really meets the road in assessing deal risk in the current market. We've seen a clear shift, particularly with the leadership at the FTC and DOJ, towards much increased scrutiny of potentially anti-competitive mergers, especially horizontal deals.
More aggressive
It
enforcement.
definitely seems that way. Reviews are taking longer, often going to a second request, which is a major information burden. Regulators appear less inclined than the past to accept traditional remedies, like simple divestitures of overlapping assets to fix competitive concerns. And crucially, they're showing a much greater willingness to actually litigate, to go to court, to try and block deals they don't like.
So more investigations, longer timelines, tougher remedies demanded, and more court battles actually happening.
That sums it up pretty well, yeah. On top of that, the CFI-US review process for foreign direct investment on national security grounds continues to be a significant and frankly growing hurdle, especially following the FIRMA legislation back in 2018 and recent executive orders. It adds another layer of potential delay, complex mitigation agreements, or even outright blockage for deals with foreign buyers.
How are the companies involved in these deals, the buyers and sellers adapting their merger agreements to this more challenging regulatory environment? Are the contracts changing?
Oh, dramatically. This is where the legal drafting is getting incredibly sophisticated and, honestly, creative. Dealmakers are negotiating much more complex, highly tailored provisions specifically designed to address this heightened regulatory risk, the potential for significant delays, and the overall uncertainty. While the core concept of allocating risk between buyer and seller isn't new, how they are writing these clauses, the specific mechanics, is definitely evolving.
Okay, let's dive into some of these key negotiated deal terms mentioned in the sources. What's happening with the outside date, that ultimate deadline for closing the deal? Are they getting longer?
Yes and no. With regulatory reviews taking longer, there's a natural pressure for longer deal timelines overall. While the initial average outside date hasn't perhaps dramatically increased across the board, we are seeing fewer deals attempting very short initial timelines, like under 5 months.
Okay.
But more importantly, there's a significant increase in the use and complexity of extension mechanisms.
Mechanisms to push the deadline back automatically if things get stuck?
Precisely. More deals now include provisions that allow one or both parties to unilaterally extend the outside date, specifically if regulatory approval hasn't been obtained by the initial deadline. The source data shows that in 2022, 68% of deals facing heightened regulatory risk had an antitrust extension mechanism, which was up notably from 56% in 2021.
So they're building in the expectation of delays. Are the extensions themselves getting longer?
Yes, that's the other key trend. These extensions aren't just happening more often, they're getting longer in duration. Nearly half of the extensions triggered in deals during 2022 were for 6 months or even more. We're seeing more deals with potential total timelines stretching out.
So the potential total timeline for these deals, including extensions, is definitely expanding. Deals could be pending for a year or more.
Yes. The data showed 45% of deals with heightened regulatory risk signed in 2022 had potential extended outside dates of a full year or even longer, compared to 38% in 2021. This trend directly reflects the market's expectation of lengthier, more uncertain regulatory review processes. It impacts the ARB's annualized yield calculation too, obviously.
What about the buyer's obligation to actually fight the regulators if they challenge the deal? Is that changing?
Huge changes here. This is covered under what are called regulatory approval efforts, covenants. Sellers, wanting deal certainty, are increasingly demanding very strong commitments from buyers to pursue regulatory approval vigorously, even if it means going to court and fighting the FTC or DOJ. The trend is towards buyers having essentially unlimited obligations to litigate a challenge from the regulators. The source noted that in 2022, virtually all, nearly 100%, of these litigation obligations found in deals facing heightened regulatory risk had no express limitations on the buyer's duty to fight in court.
So the buyer potentially signs up to fight in court indefinitely, spend whatever it takes. That's a big commitment.
It's a massive commitment.
Yeah.
Now, on the flip side of that negotiation, perhaps reflecting the buyer pushing back, we're also seeing a significant increase in deals where the buyer explicitly has no obligation whatsoever to divest assets, sell off parts of the business to satisfy regulators, and get the deal clear.
Really, no requirement to sell anything.
That percentage jumped sharply to almost 42% in 2022, way up from 23% in 2021. This implies a take-it-or-leave-it approach by the buyer regarding the combined entity, forcing the regulator's hand towards litigation if they have concerns. It's a harder line being drawn. There's also this emerging strategy called fix it first, where companies might proactively agree to divest specific assets before closing, contingent on the main deal completing. Sometimes they hope this strengthens their litigation posture if regulators still sue to block the remaining core transaction. And we're seeing more specific efforts, covenants related purely to navigating the CFIUS process too.
It sounds like parties are also getting more creative about sharing the economic burdens and pain of these delays and uncertainties, especially with higher interest rates now.
Absolutely. The longer reviews and the increased potential for litigation introduce significant costs and risks, especially the time value of money risk for the seller. So provisions to formally allocate economic risk are becoming more important and more negotiated. Ticking fees are one mechanism we see sometimes.
Ticking fees, like a meter running.
Kind of, yeah. These are clauses where the per-share purchase price actually increases by a small, pre-agreed amount for each day or week. The closing is delayed beyond a certain date. It's meant to compensate the seller for the time value of money and also incentivize the buyer to get the deal closed faster.
Do you see ticking fees often in practice?
In U.S. public deals, they're still relatively rare, honestly. The source only found them in a handful of deals in 2022. When they do appear, they can take some unorthodox forms, like having the fee rate step up over time, or even involving direct cash payments to the seller shareholders instead of adjusting the deal price. Buyers generally push back very hard against agreeing to ticking fees, especially if they've already agreed to those strong, potentially unlimited litigation obligations. They don't want to pay to litigate and pay a ticking fee.
Makes sense. What about reverse termination fees, RTFs? You mentioned those earlier. These are payments the buyer makes to the seller if the deal breaks due to specific reasons, right? Often regulatory failure.
Yes, exactly. And they are increasingly being tied specifically to failure to obtain antitrust or sometimes CFIUS approval. Unlike traditional seller break fees, paid if the seller takes a higher offer, RTFs paid by the buyer are not legally capped by Delaware court precedent in the same way.
So they can be bigger.
Much bigger, potentially. This has allowed them to increase significantly in size recently. The source data show the average antitrust-related RTF rose to 5.69% of equity value in 2022, up from 4.5% in 2020. And a substantial portion of these fees are now 6% of equity value, or even higher. These larger RTFs essentially make taking on the regulatory risk much more palatable for sellers. They are getting significant compensation if the buyer fails to get the deal through the regulators.
So higher stakes for the buyer if they can't close due to regulatory issues. Are the parties also sharing the actual costs of the regulatory review process itself more often? Filing fees and such?
Yes, fee sharing for significant regulatory filing fees, particularly for the antitrust, HSR filing, and any CFIUS submissions, is becoming more common. These fees can be quite substantial for large, complex deals, so agreeing to split them is becoming more standard practice.
Beyond allocating the economic risks, are there also more detailed agreements about how the parties will cooperate and who calls the shots during the actual review process?
Definitely. Process covenants are getting more detailed and specific. These outline requirements for cooperation between the buyer and seller during the regulatory investigation, things like providing information promptly, responding to agency requests, allowing access to personnel, often phrased as using reasonable best efforts.
Who's in charge of the strategy?
That's also being negotiated. Buyers, who usually bear the brunt of the regulatory risk, especially if paying an RTF, are increasingly negotiating for more explicit strategic control over how the regulatory approval process is managed, including deciding the arguments made to the agencies and whether or not to litigate.
And finally, how are these complex regulatory outcomes being written into the actual closing conditions of the deal? Are those getting more specific too?
Yes, this is another key area of evolution, adapting to new regulatory realities. For instance, regulators like the FTC have started issuing things like pre-consummation warning letters when their investigation goes past the standard HSR waiting period but isn't finished. Deal agreements are now starting to explicitly address how these letters impact the ability to close.
How are they handling them?
Generally, the trend seems to be not defining receipt of such a letter as a deal-breaking event or a failure of a closing condition, but it might trigger a delay mechanism or require further discussion. We expect this type of specific condition addressing interim regulatory actions to become more customary. Also, given the increased likelihood of litigation, expect to see more provisions clarifying whether parties can close the deal between regulators losing a preliminary injunction fight in court and any subsequent appeal, which can take a long time.
And what about CFIUS specifically in the closing conditions? Any new trends there?
CFIUS closing conditions are absolutely increasing in prevalence as more deals trigger CFIUS jurisdiction. More deals explicitly require CFI-US clearance as a condition to close. Agreements are also getting more granular in addressing nuanced CFI-US outcomes, like what happens if CFI-US issues a shoulder shrug letter, basically declining to take action on a short-form voluntary filing, but reserving the right to look again later.
How do buyers and sellers view that shoulder shrug?
Sellers typically want the ability to close on just a shrug letter, viewing it as sufficient clearance for practical purposes. Buyers, however, might prefer the greater legal certainty and safe harbor that comes from obtaining a full formal clearance letter from CFI-US, even if it requires filing a longer, more detailed formal notice and enduring a much longer review process. That tension gets negotiated.
Any other novel CFI-US terms?
We're also seeing incredibly detailed, sometimes quite novel, CFI-US procedural conditions being negotiated, things like agreements on whether or not to file voluntarily in the first place, specific timelines for making submissions, or conditions that spring into effect only if CFI-US expresses interest or requests a formal filing. Sellers might even include representations in the agreement stating that their business doesn't trigger a mandatory CFI-US filing if they plan to avoid submitting one altogether.
Wow. So assessing closing probability today requires not just understanding the regulatory agencies and the companies involved, but also deeply analyzing these highly specific, often creatively drafted, and constantly evolving legal clauses buried in the merger agreement.
Precisely. The evolving regulatory landscape and the complex, sophisticated terms dealmakers are using to manage it are absolutely critical inputs for any merger arbitrager assessing the probability of a deal closing, the potential timeline, and the specific risks involved today. It's really no longer enough to just know the big picture regulatory risks. You need to understand exactly how the parties have contractually agreed to allocate and address those risks between themselves. That contract is king.
Okay, so you've done all this meticulous analysis, avoided the red flags like the buy-side vote, determined the potential yield, assessed the alpha rank risk, calculated your position size based on the estimated downside, and carefully factored in all these modern regulatory complexities and negotiated terms.
Yeah.
You've decided this is a deal worth putting capital into. What are the mechanics of actually placing the trade? How do you get it done?
Right, the execution.
Right.
The trading mechanics themselves depend primarily on the type of consideration being offered in the deal. For an all-cash deal, it's relatively simple. You just place an order to buy the target company's stock at a price that leaves you with an acceptable spread and potential annualized yield, based on your analysis.
Buy the target, wait for cash, simple enough. And for stock deals, where you're also shorting the buyer's stock, more moving parts there.
Definitely more complicated. And it introduces another layer of significant risk. Borrow risk. You absolutely must confirm that you can secure the short borrow for the acquiring company's stock before you execute your trade.
You need to know you can actually borrow the shares to short them.
Exactly. If the acquirer's stock is known to be hard to borrow or very expensive to borrow, high borrow fees eat your spread, or if there's a perceived high risk that your borrowed shares could be recalled by the lender before the deal closes, that could be a reason to pass on the deal entirely, even if everything else looks good on paper.
Why is a recall so bad?
Getting your short position recalled prematurely forces you to buy back the acquirer's shares in the open market to return them to the lender. If this happens while the stock price is rising, or worse during a short squeeze, it can be absolutely disastrous for that leg of your trade. You have to manage borrow risk carefully.
Okay, assuming you can secure the borrow at a reasonable cost, how do you execute both sides?
Then you typically use a specialized trading system, often called a pair trader, or a similar functionality offered by prime brokers. This system is designed to execute both legs of the trade, buying the target stock and shorting the acquired stock simultaneously and in the correct ratio according to the merger agreement's exchange term.
Both at the same time.
As close to simultaneously as possible, yes. This minimizes the legging risk, the risk of adverse price movements between placing the buy order for the target and the short order for the acquirer. Minimizing that slippage is crucial for locking in the desired spread accurately, especially in fast-moving or volatile markets. Speed and efficiency in execution are really key here.
So the trade is on, you're long the target, maybe short the acquirer. What happens from that point until the deal actually closes? Sit back and relax.
Definitely not relax. As we discussed earlier, you remain firmly in monitor mode. You are waiting, sometimes patiently, sometimes anxiously, for all the conditions to closing specified back in that merger agreement to be satisfied. This is absolutely not passive investing or putting the position on cruise control. Far from it.
What are you primarily watching for during this waiting period? What needs to happen?
You're constantly monitoring all the news flow from both companies, their ongoing financial results, any relevant sector-specific developments. But crucially, you're tracking the progress towards satisfying those specific closing conditions we found in the merger agreement. Has the required shareholder vote happened yet? What were the results? Did it pass comfortably? Are the regulatory agencies providing any public updates on their review? Is there any news about the financing commitments holding up?
So, ticking off the boxes on the closing conditions list.
Exactly. You're also constantly scanning for potential negative signals, any hint of unexpected regulatory roadblocks, problems emerging with the financing, unexpected poor performance from the target company that might trigger a material adverse effect clause, or any signs that the buyer might be getting cold feet or trying to renegotiate.
And conversely, still hoping for positive signs, too.
Always. Still hoping for positive signs like stronger than expected earnings from the target or positive signals from regulators that could push the deal forward more quickly or maybe even result in that coveted price increase or a competing bid emerging.
The timeline for this monitoring phase can vary dramatically, right? Could be weeks or years.
Wildly. A simple, friendly, all-cash tender offer with no regulatory issues might close in as little as 45 days, sometimes even less. But a complex cross-border merger with significant antitrust or foreign investment review, maybe involving litigation, that could easily take many months, even a year, or in rare cases, close to 2 years to finally close, especially considering the trend towards longer outside dates and extensions we talked about. Patience is often required.
And finally, let's say everything goes well. All the conditions are met, the regulators sign off, shareholders approve, the outside date hasn't passed, the deal is officially completed. How does the arbitrager actually realize their profit? How did it get paid?
The closing.
Okay.
At the official closing, the target company effectively merges into the acquirer or ceases to exist as a separate entity. If it was an all-cash deal, the cash consideration specified in the agreement is simply deposited into your brokerage account in exchange for the target shares you held.
Cash appears.
Cash appears. If it was a stock deal or a mixed cash and stock deal, you receive the specified number of shares of the acquiring company and any cash component in your account in exchange for your target shares.
And if you were short the acquirer?
If you were short the acquirer as a hedge, you then use those shares of the acquirer that you just received to cover or close out your short position. The difference between the value you effectively paid for the target stock, including your hedge, and the value you received at closing represents your captured profit, the spread. The trade is complete, the spread is locked in.
It's clear that success in this space is so much less about predicting broad market direction and almost everything about rigorous, detailed analysis, sticking to a process, and just disciplined risk management at every step.
Absolutely.
Yeah.
And it all cycles back to those core principles we started with, like Buffett's fundamental never lose money. Merger arbitrage isn't about hitting speculative home runs based on gut feelings. It's about trying to generate consistent, relatively low-risk returns by focusing intently on the probability of a specific corporate event happening.
Right.
It really embodies Charlie Munger's famous advice that much of business and investment success comes from trying to be consistently not stupid instead of trying to be very intelligent.
Consistently not stupid. That's a great way to frame the whole arbitrage philosophy, isn't it?
It really is. Instead of trying to outsmart the entire market with complex macro predictions, you focus on avoiding known pitfalls, like that buy-side vote, carefully analyzing the specific deal terms and probabilities, using checklists to eliminate deals with obvious unacceptable risks, and diligently managing your potential downside exposure through careful position sizing and broad diversification.
Protect the capital first.
Protect the capital first. You concentrate on not making big mistakes, on protecting your capital, and the positive returns from the spreads on the deals that do close successfully tend to accumulate over time across the portfolio.
This deep dive has really opened up the intricate world of assessing M&A deal risk, specifically through the lens of a merger arbitrage practitioner. We've seen how they systematically dissect public documents like the press release, the merger agreement, the proxy statement, all those key docs.
Digging through the details.
How they quantify potential returns using the merger yield calculation and gauge the market's perception of risk with the implied odds calculation. How they lean on internal risk rating systems like the Alpha Rank example, to guide decisions.
Yep, translating analysis into a rating.
How they apply those critical checklists to avoid inherently dangerous situations, especially that buy-side vote pitfall you highlighted, and how they manage portfolio risk through disciplined position sizing based on estimated downside and diversification across deals and sectors, fully acknowledging that some deals just will inevitably break.
That's the core process. And we've also explored how the current, arguably more aggressive U.S. regulatory environment, with that increased scrutiny from the FTC, DOJ, and CFIUS, is adding significant layers of complexity.
Right, the new landscape.
It's pushing dealmakers to negotiate increasingly sophisticated and tailored terms around timelines, like those automatic extensions, around litigation obligations, sometimes unlimited, and around the allocation of economic risk through things like potentially larger reverse termination fees. Understanding how these evolving provisions impact deal certainty and timelines is now absolutely critical for any arbitrager.
It certainly highlights the sheer amount of detailed, often tedious legal and financial work, plus the continuous monitoring required for each potential investment. And also the discipline it takes to just walk away, to say no when the analysis reveals the risks are simply too high, even if the potential reward looks tempting.
It's ultimately a probability game, as you said, but it's one where applying a rigorous discipline process focused squarely on identifying and managing the downside significantly increases your odds of success and survival over the long term.
So here's a final thought to leave you with, building on that theme of increasing complexity. Given the increasing complexity of regulatory reviews we've discussed, the expanding timelines for deal completion, and the sophisticated, often novel legal terms now being negotiated to manage these risks, from ticking fees to escalating RTFs and highly detailed CFIUS conditions, how might these evolving dynamics fundamentally reshape who can effectively participate in merger arbitrage and perhaps even M&A itself in the financial markets of the future? Does this increased complexity and the heavy reliance on detailed legal and regulatory analysis effectively raise the barrier to entry, favoring larger, more specialized players? Something to consider as you watch the next big deal unfold in the headlines.
That's a fascinating question, actually, a very pertinent one given the trends we've just discussed. Definitely food for thought.
That's all for this deep dive. Thanks for joining us.